Ladies and gentlemen, good day and welcome to M&B Engineering Limited Q4 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during this conference, please signal for an operator by pressing star and then 0 on your touch-tone telephones. Please note that this conference call is being recorded. I now hand the conference over to Ms. Krishna Patel from EY. Thank you, and over to you, ma'am.
Thank you, Farah, and good afternoon, everyone. We welcome you all to M&B Engineering Limited Q4 FY26 earnings conference call. To take us through the results and to answer your questions, we have with us today the management of M&B Engineering, represented by Mr. Chirag Patel, the Joint Managing Director, Mr. Malav Patel, Joint Managing Director, Mr. Sanjay Majumdar, Director, Mr. Keyur Shah, the Chief Financial Officer. Please note that the discussions that we may have today may contain certain forward-looking statements relating to future events and future performance. Numerous factors could cause actual results to differ materially from those in the forward-looking statements. Please note the audio of the earnings call is the copyright material of M&B Engineering and cannot be copied, rebroadcasted, attributed in press or media without specific written consent of the company. Now, I would like to hand over the call to Mr. Malav Patel for his opening comments. Thank you, and over to you, sir.
Thank you, Krishna, for the introduction. Good evening, everyone, and welcome to M&B Engineering Limited's earnings conference call for the fourth quarter and full year ended March 31st, 2026. We concluded our board meeting earlier today, and I trust you've had the chance to review the financial results and investor presentation uploaded on the stock exchanges and on our company's website. I will begin by highlighting the key performance drivers for the quarter and the full year, followed by an update on our business segments and our outlook for the coming year. FY26 has been a landmark year for M&B Engineering, reflecting strong growth across our key operational and financial metrics. Revenue from operations grew 27% year-on-year to 1,259.7 crore in FY26. While Q4 FY26 revenue increased by 16% to 363.7 crore. This performance was broadly in line with our guidance and was supported by a robust order book, strong execution capabilities, and healthy order inflows across a diverse portfolio of businesses, enabling us to deliver projects efficiently and on time. EBITDA for FY26 increased by 17% to 157.2 crores, and profit after tax grew by 20% to 92.6 crore. While we delivered healthy annual growth, profitability came under a little bit of pressure in the year, particularly in Q4 FY26, due to macroeconomic headwinds and foreign currency volatility. I would also like to highlight a positive development on the tariff front. This is the US tariff. The sectoral import tariff in the US market has recently been reduced by 25%. This is a meaningful improvement, and we expect it to enhance competitiveness and improve traction in the US market going forward. During FY26, we incurred capital expenditure of 33 crores, primarily towards capacity augmentation and operational strengthening in line with our midterm growth strategy. Looking ahead, our estimated capex for the year is around 100 crores, reflecting our continued commitment to expanding capability and scale. As of March 31st, 2026, our unexecuted order book stood at 1,083 crore, representing a 35% year-on-year growth and providing strong visibility for future execution. Of this, the Proflex division accounts for 20% or 212 crores, while the Phoenix division contributes 80% or 871 crores. Within the Phoenix order book, export orders account for 279 crores or 32%, with the balance coming from domestic orders. We also achieved our highest ever order inflow of 1,539 crores, up 28% year-on-year. This reflects the increasing adoption of pre-engineered buildings and the continued shift from conventional methods. During March 2026, we received a major domestic order worth 73.18 crores in the Phoenix division for the design, engineering, and supply of a pre-engineered building. This shall be executed over the next 5 months. More recently, in April 2026, we received another domestic order worth 71.95 crore for a similar scope to be completed in 7.5 months. The Phoenix division delivered a revenue of 985 crores in FY26, a growth of 29%, driven by a strong demand in both domestic and export markets. Export revenue rose sharply to 165.6 crores, up 156% year-on-year, reflecting our expanding international presence, strengthening market demand, and improved scalability. Our focus remains on North America, which is catered to by our Sanand plant. This is currently the only PEB plant in India with the AISC certification, a key requirement for most general contractors in the United States. The Sanand plant also holds the CWB certification, the Canadian Welding Bureau, which is mandatory to supply into the Canadian market. In addition, we have built a strong marketing presence in the eastern United States and are steadily strengthening our position by supplying PEBs and structural steel for large industrial buildings. This combination of globally recognized certification and on-ground market presence gives us a clear early mover advantage in one of the world's most attractive markets. The Phoenix division has now been operating for over 15 years, has completed more than 1,650 projects, and has installed over 7.1 lakh metric tons till date. We are also in the process of adding approximately 20,000 metric tons of capacity in our Sanand facility, which is expected to be commissioned in Q2 FY27. Once this expansion is completed, total installed capacity at Sanand will increase to 92,000 metric tons per annum. Thereafter, we plan to begin expansion at the Cheyyar plant, which is in Tamil Nadu, with the aim of making it operational by Q1 or Q2 of FY28. The Proflex division reported FY26 revenue of 275 crores, growing 23%, and continues to lead the self-supported roofing segment in India. The division has now completed 8,600 projects over 24 years of operations and has installed more than 20.3 million square meters till date, reflecting the strength of our execution capabilities, scale, and long-lasting customer relationships. We received one new unit from the UAE in December of 2025, which was commissioned in January 2026. The remaining two new units from the US are expected to be commissioned in Q2 FY27. Once these additions are fully operational, Proflex's installed capacity will increase by approximately 200,000 metric tons per annum, strengthening our ability to meet growing demand and improve turnaround times. For FY27, we remain confident of delivering top-line growth of around 25% year-on-year, supported by the strong order book already in hand and the continued rise in demands for pre-engineered buildings and self-supported roofing systems across different sectors. At the same time, we expect some near-term challenges. The impact of the Iran conflict is likely to be reflected in the short term, particularly through margin pressure and execution delays. Labor availability constraints, which are typical in the first quarter, along with monsoon-related challenges in Q2, may also result in softer performance in the first half of the year. However, as our historical trend suggests, the second half of the year has consistently been stronger for us. We therefore encourage our investors to assess our performance on a full-year basis rather than a quarter-by-quarter. In summary, we remain focused on disciplined execution, delivering high-quality projects, leveraging our expanded capacities, and strengthening our presence across the domestic and export markets. With a comfortable order book, a visible bid pipeline, improving execution momentum, and targeted capacity investments, we are confident of sustaining our growth trajectory. With that, I now will hand over the call to our CFO, Mr. Keyur Shah, to walk you through the financial performance in a greater detail. Over to you, Keyur.
Thank you, Malav, and good afternoon, everyone. A warm welcome to the earnings conference call of M&B Engineering Limited. I shall summarize the consolidated financial highlights for the quarter and full year ending 31st March 2026. Quarter 4 of financial year 26 vis-a-vis quarter 4 of financial year 25, we have a revenue from operations stood at 364 crore, reflecting a 16% growth compared to 314 crore in FY25. Q4 FY25. EBITDA for the quarter was 43 crores, marginally lower by 2% versus 44 crore in Q4 of FY25. EBITDA margin stood at 11.9% compared to 14% in the corresponding quarter last year. Profit after tax was 27 crore, a decline of 5% from 29 crore in Q4 of financial year 25. Now, full year 26 vis-a-vis full year 25, revenue from operations for full year 26 stood at 1260 crore, registering a strong 27% growth over 989 crore in FY25. EBITDA increased to 157 crore, up 17% from 135 crore in FY25. EBITDA margin was 12.5% as against 30.6% in FY25. PAT increased to 93 crore, a 20% growth over 77 crore in FY25. PAT margin stood at 7.4% compared to 7.8% in the previous year. The reduction in margin in Q4 and FY26 are due to forex loss, net loss of 3.9 crores and 6.04 crores respectively in Q4 and FY, booked as other expense in Q4 due to sharp rupee depreciation, which includes unrealized loss of 3.83 crores, over 20% steep increase in the steel prices in domestic market, which hit the procurement cost of uncovered raw material, and sharp increase in export freight cost due to war impact. If we remove forex loss, adjusted EBITDA will be 13% in Q4 as well as full financial year 26. Export revenue came in at 166 crore, representing a significant 156% year-on-year growth. Net working capital stood at 39 days as of March 26 as compared to 33 days of March 25. Out of the net IPO proceeds of 259.32 crore, 137.81 crore has been utilized so far. That is 53% of the funds have been utilized as on March 31st, 2026. During the quarter, 7.5 crore was utilized. CapEx incurred in FY26 was 33 crores and CapEx planned to be incurred in FY27 is around 100 crores, which will include CapEx for Sanand plant expansion, part CapEx for chair plant expansion, which will be incurred in H2, and other regular CapEx. That concludes with my update on the financial highlights of the company. I shall now request the moderator to open the floor for Q&A session.
I will just add very quickly, Keyur. Just one very important piece. The total other income of 5.29 crores in Q4 and 15.67 crores for the full year actually includes 2.69 crores in Q4 as operating other income and about 9.63 crores on the whole year basis as operating other income, which is primarily our export incentives and other operating income, which we include as an operating income. This is just an additional data. Over to you, moderator. Let's open the house.
Sure, sir. Thank you very much. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may enter star followed by 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may enter star and 2. Participants are requested to please use only handsets while asking a question. We will wait for a moment while the question queue assembles. The first question is from the line of Disha. Please go ahead.
Hello.
Yes.
Am I audible, sir?
Yes.
Yes. Thank you so much for this opportunity. So firstly, my question was on the EBITDA margins. You mentioned that we saw some pressure due to the war impact. So how do you see the margins overall for FY27 given the geopolitical? Yeah.
So Disha, we have been actually internally working on this. First and foremost, let's understand there are a lot of moving pieces which are still not under our control. While of course the management endeavor will be to make sure that whatever best we can do in terms of margins is fructified, but we feel that this is a bit premature for us to give any margin guidance for FY26-27 for 3 very clear reasons. One, the whole costing currently, as you know, steel prices have gone up by 20% just in last quarter. Then the freights are very uncertain on the export freight, availability of containers and freight, it keeps on fluctuating very widely. FX, we are not able to control exactly. While of course we have a good export order book of about 280 crores, we are hopeful of a continued stronger margin profile, but we want to wait and watch for at least one more quarter before which we will give any specific margin guidance.
Yes. At least till the conflict ends and there is more clarity.
Some more clarity.
Yes, because too much of volatility and uncertainty factors, right, which are becoming misleading. So we want to avoid giving you any guidance as far as that goes. But growth, as far as top line goes, I clearly mentioned in my speech that we are quite hopeful and confident about at least 23-25% growth because our order book is strong going forward, as well as the pipeline, the kind of capex that is happening in the country, and our increased focus in the export market. We are quite confident about achieving the top lines that I've just mentioned.
Okay, fair enough, sir. And so coming on to your export mix, given you mentioned that the tariff situation in North America is much better, how do you see the overall export revenues this year, and what sort of pipeline do we have currently, and what sort of order inflows are we expecting for this year?
Very honestly speaking, Disha, whatever plan we have as a top line for the current fiscal, we already have that much work on hand, So going forward, while there is pressure because of inflationary factors in the US, the order closing has become a little bit longish, while our team is constantly endeavoring, being in touch with our end users, generating inquiries. The closure of the orders or the inquiries is not coming in as quickly as it used to 4 months back. But we are quite hopeful. Our exercise is on. We are there on the ground and trying to fetch for new orders. With the new tariffs, the reduction, of course, it is going to be a very balanced approach. We are going to try and improve our margin as well as create a good order book going forward. So it's going to be a good balance, and this reduction in tariffs has definitely given us more opportunity to do that.
But I think we should be doing at least around 300 crores in this year on the exports, as against 165.
Yeah.
Okay, that is really good to know. So, and what sort of margin differential do we see in export projects and domestic projects? If you could just give more detail on that.
So currently, Disha, at the current cost structure and pricing structure, we are looking at about 16-17% EBITDA on the exports, vis-a-vis currently about 10-11% that we are getting in the domestic market.
Okay. And so just on the pipeline for the domestic front, any sort of number we have? While exports, I understand it's going to be a bit challenging for you to give me a number but for domestic, do we have any sort of number for the order pipeline that we're currently chasing?
Order pipeline, generally it is, meaning one thing I must say that our market has shown some real resilience, because the pipeline or the inquiries on hand that we've had since the last 3 months are probably topping the remaining part of the year that just passed, We are quite confident, given the pipeline that we have, that going forward as well, it will actually be depending more on my appetite to grab new orders, right? Rather than market, whether capex is happening or not. So I think we are in a good situation in a lot of ways, but these costs need to come under control. We'd be all the more confident about the order intake.
Just to add to that, this is Aditya. As of now, the pipeline would be in excess of 1,000 crores.
Yes.
Firm inquiries or
firm inquiries?
Quotation
submitted, firm inquiries going on.
Coming from different industries, different sectors, yes.
Domestic, specifically.
To put things in perspective, like Aditya said, you can consider about 1,100 crores of pipeline.
Okay. And so this 20,000 metric ton capacity that we're adding in Sanand, which we are on track for commissioning by 2Q, we don't see any delays.
Yeah. Q2 has been the plan, and we are going to stick to it.
Okay. That is great to know. Thank you, sir. That is it from my side. And wishing you all the best.
Thank you. Participants with questions may enter star and one on their handsets. The next question is from the line of Hussain Bharuchwala from Carnelian Capital. Please go ahead.
Hello.
Yes. Yes.
Your voice is very feeble, sir. Could you please speak up?
Yeah. Am I audible now?
Yes, sir. Please go ahead.
Yes. Sir, if you can just give us the breakup of the volume in terms of exports for the full year and for the domestic, that would be great, sir.
What we did last year, you mean?
Yeah, this year. FY26, for the year that we just finished.
FY26, no. What is that? This is what?
Yeah.
No.
So export turnover for financial year 26 is 7,045 tons. Out of total 73,000, 7,000 is export.
Yes.
7,000 is exports. And if you can give us the breakup of the other expenses that have shot up. I think you said about the forex part, but what were the other reasons, if you can give us some breakup of that?
Pardon, other?
I think mainly it is the expense rate.
Yes.
Almost 50 crores plus is due to export. Okay,
yes. There are three expenses, major expenses, which is export duty, custom duty, export freight, sea freight, and transportation, which we incur in this USA after delivery to the site. So these are the three major expenditure, which comes to around 40 to 45 crores out of the total.
Okay. And so the large part which has shot up is one of the reasons is exports. I think, sorry, on the forex side, we lost 4-5 crores because of the forex. On the logistics front, how much was the additional impact because of the war, if you can quantify that?
See, out of 6 crore of forex, 3.839 crore is of the last quarter, and out of which 3.83 crore is unrealized loss. What is mean is, this is based on the rate as on 31st March 26, right?
Which was 95 almost, yeah.
Which was 94.78. So this is the impact of war on the forex.
Yes.
Okay, so 3.8 crore is the impact of war on the forex, basically. Forex impact on the P&L.
From end of February till, let's say, end of March. In a month.
Got it.
In a month.
And so just wanted to understand on the Phoenix side, I think the volume growth for this quarter was quite weak. Any specific reason on the PEB side? I think the volume growth was, when you look at the year-on-year volume growth, it was just 8% growth. So what was the prime reason for such a low volume growth in this quarter?
I'll give you a couple of examples. See, the input materials right after the war started. See, generally January, February, March में हमारा अच्छा खासा growth रहता है. But all the input materials which go into my manufacturing process, starting with the raw materials, delivery started getting hampered, right? And I would have lost about 10-15% volume, which I can account to the war situation. The steel import, gas, gas supplies, the mills were closed because the mills use humongous amounts of gas in the production process, right? So multiple factors, and that is one of the major reasons why we were not able to deliver the volume that we projected originally.
Okay, so the raw materials availability was one of the key concerns, as well as the raw material costs have gone up, so the customers are delayed.
हमारे वहाँ भी gas use होता है, right? In our production process also we use gas. So there were days when we did not have any gas, right? So all this trickled down to loss of production and the eventual volume.
Still we achieved 8% growth with all this
So rather than a 15% growth, we got 8% growth. That was the result.
Got it. And when you say for next year, I think 25% guidance that you have given. So in that, how much volume growth that you are factoring in?
Volume, हमारा Phoenix में for pre-engineered buildings will go from 72 to 90,000.
Okay.
Right. And in Proflex it will go to 17 to 17.25 lakhs. 17.25 lakhs.
Square meter.
And Proflex and Phoenix में 85 to 90,000. That's the volume growth we are planning. About 20-25%.
Got it. Got it. So if the war would not have been there, so you were expecting around 15% volume growth in this quarter as well, but because of the war, you were able to only do 8%.
Yes, correct.
Got it. Got it. And is there any slowdown in the demand, if you can highlight on that front, on the PEB side? Is there any slowdown?
So as I said for the earlier question from Disha, there's enough traction in the market. CapEx is still happening. There we have not seen any slowdown in the number of inquiries or the kind of projects. ऐसा भी नहीं है. Even a warehousing developer is continuing with his development, and even a gigafactory is being built today. So we are not seeing any slowdown so far.
Okay.
The pipeline.
And even at higher steel prices, people are ready to buy. Is what you are indicating.
Yes. अभी मोदी जी ने oil and gas महंगा किया है, तो अभी let's see how things pan out.
Got it. Got it. Okay. Okay. That's it from my side. Thank you. Thank you.
Yeah. Thank you.
Thank you. The next question is from the line of Shubhankar Gupta from Equity Capital. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yeah.
Yes, please go ahead.
Got it. Got it. So just, I think first question is on the order book itself. So, the PPT says that, order inflow was at around 390 crores, out of which 75 was from domestic, right? Which means a global order book would be 315 crores, right? So just want to understand.
No. I'll correct you. The total order book in Q4 was about 388 crores. That was majority of that was from the domestic market. We just highlighted one of the large orders that we got in Q4, which was somewhere in the 70s of crores.
Okay. Got it. So I think I got it wrong then.
From the Indian market.
Okay. Majority is from Indian market. Got it.
Yes.
Okay. And just want to understand, sir, just building on to Hussein's question. So export turnover for this year is 7,000 tons out of 73K tons, right? Around 9-10%.
Last year, yes. FY26, correct.
FY26, right.
Yes.
So I just want to understand how has this number trended over the last 3-4 years, from 21 to 24, from 22 to 25 FY, and then how do you see it moving in the coming foreseeable years? Is there some estimate you've taken?
Yes.
Sir, for export, we we have 2,400 ton done in 25. 26, it is 7,400 ton, and we expect 10,000 ton to be exported in 27, FY27.
Going forward, the target is to maintain at least a 20-25% growth.
Yeah. Yes.
Easily.
Of course, across domestic and.
I have to give a disclaimer under normal operating conditions.
Yes, and I will, and Keyur can also share the numbers which we achieved as far as export goes further than FY24, right? He will give you that number.
That was very nominal.
Those were very nominal numbers. You can say that our major traction started 2 years back. Right, and today we stand at 7,000. Next year we are targeting somewhere around 10,000. So anywhere between 20 and 25% growth we are going to chase.
Okay. I think that's helpful. Sir. So I think you also mentioned that Q4 you were expecting 15% growth, right? We saw 8%. Just wanted to understand. So along with let's say the gas impact which you mentioned in the gas which is used in the production process. What were the other second order impacts of this war which have led to this, let's say, like if you had to allocate other reasons?
One major was the steel mills were not delivering on time because they also operate on gas, right? And mills band bhi thi in the month of March. Entire month of March, 2 major suppliers in India were shut down, right? We were relying only on one other steel supplier, and that disrupted our material inflow. So that was another major reason, even beyond gas, I would say.
Okay, sir. So just kind of wanted to understand the supply side of the raw material. So going forward, are we planning to stick to these 2 main suppliers, or are we more, let's say, now more fragmented in terms of our supply side? How is it building now?
We generally rely on these 3 suppliers who have been delivering on time till date, but abhi jo hua, that was an extraordinary situation. These extraordinary
Absolutely.
situations don't come very often, right?
Sir, they are the largest.
We are talking about Tata, JSW,
and IAM and
Mittal, they are reliable.
But anyway, now things are normal. Now
अभी आ रहा है, अभी महंगा हो गया है steel, that's another thing, but supplies are in place.
Steel prices have been increased in India in the last quarter by 20% plus.
Yes.
Frankly, thanks to
MIP.
Because
minimum import
prices are linked to dollars and freight and everything. So जितना import का भाव बढ़ता है, domestic mills immediately jack up the pricing.
Correct.
Okay. Got it. No, so that's helpful. And I think those were my questions mainly. Thank you for answering so nicely.
Yeah. Thank you.
Thank you.
Thanks.
The next question is from the line of Anurag Patil from Quest Investment Managers. Please go ahead.
Thank you for the opportunity. So, sir, on the data center side, what is the actual scope of work for us?
See, the quantum is, I can say in a very simple language, that it will lead to a very humongous quantity coming in the next 5 to 7 years. But still, the Indian companies, the Indian developers who are into data center development, they contemplate between iron, steel and concrete, right? Because they're still exploring. The subject is new for them. Of course, they have international tie-ups, international consultants working on this. So actual number I will not be able to give you because it is still in a very, very nascent stage. There's only 1 or 2 companies which have actually executed data centers. One of them is Adani and the other one I think is Hiranandani or Raheja. In dono ne actual data centers they have put in place, right? But a lot of them are yet to come in the market. Now what technology they use, how quickly they are going to come up with it, that is still premature to say.
Just to add to perspective, one data center, thumb rule average is roughly around 12 to 15,000 tons.
Of PEB. One data center would be 12 to 15,000 ton steel. Just to put things in perspective.
Okay. But specifically with regard to data center, concrete versus steel, how do we fare basically? If you can throw some light on that side.
Again, it is in a very, very premature stage because we are currently, in fact, working on a couple of inquiries for data centers, and the quantum would be around 50 to 60,000 tons, right? Now, actual designs, we are still in the process of understanding, and we really are unaware of what is going into making it with concrete. So, once we actually execute a couple of them, I think we will not be able to give you that answer. But steel has its advantages. It is much quicker. It has a much faster turnaround time, right? And the developers, if not today, will tomorrow see this difference in execution speed, and which will be the winner again for steel construction.
Okay, fair enough. And second question, sir, on the chair facility, we want to increase our utilization in FY27, but do we have enough order book from the South India region to ramp up that?
Yes. हमारा जो ये साल का टारगेट है उतना तो काम है ही, और it's in a very final stages of closure. We have good amount of work on hand which we can deliver in the next 6 to 8 months. Currently we are working on orders which will come into execution beyond that.
Okay, sir. That is from my side. Thank you very much.
Yeah. Thank you.
Thank you, Anurag.
Thank you. The next question is from the line of Vandit Shah from Abacus Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, just one question I had. We have given the guidance of 85,000 tons. This is 20% volume growth. Secondly, we have even spoken that the steel prices have gone up by 20% quarter. I understand the order in hand will take 6 months for the completion. But can this 25...
A little bit more.
So assuming 7 to 8 months of completion.
It will take around 8.5 months.
So the new orders, if the current steel prices are at the same level, then the new orders will be at the increased price, right?
Higher price. Coming at a higher price, yes.
So that effect will be seen in FY27 or FY28?
Partly in this year, partly in the next year.
So there can be a situation that 25% revenue growth, we can outpace that based on the pricing.
Could be. You're right. Could be. You're right. Bang on. Correct.
And so secondly, on the this exports front, now the tariff situation, the tariffs have reduced to 25%. So currently we are paying 25% tariff, right?
Yes, that's right. Yes.
So while it was 50%, we were meeting the same margins around 16-17% in export or was there. So despite the tariffs going down, we are not increasing the margin.
One is we are going to try for, as I said in my earlier answer, I am going to try and balance out my margin improvement and getting new orders, but thereby increasing my customer base. I am being a little pessimistic while giving you the margins, right? Because my input costs and all are still not exactly in my control, right? I may book something today, but I don't know what the freight rates are going to be tomorrow. So I did not want to give any margin guidance, whether it was for export or domestic, but this is just to throw a number at you. We have spoken this number, but I till I do not have control on my input costs, we will not be able to commit or give any guidance about these numbers.
Got it. And sir, lastly, so our export work is like we ship from here to our company in the US, and then US company sells all over the places, correct?
Yes.
So how do we manage a freight cost, like if we want to protect ourselves in the current situation? So is there any strategy in place to protect that freight?
Since this steep increase in the last month and a half, since the war began, we have started adding a little bit of more cushion, right? What increases happened now, there was a $2,000 of war surcharge which the shipping line started imposing over and above the regular freight rates, right? So when such an increase, you can never plan for such an increase, right? You can maybe provide for a little bit of cushion, but now today when I'm quoting for a job, I am adding adequate cushion so that, if at all the oil prices go up even beyond what they are today, then I'll be covered to an extent.
So the participant's line's been disconnected. We'll move on to the next question. The next question is from the line of Aniket Madhwani from Step Trade Capital. Please go ahead.
Yeah, hello. Am I audible?
Yeah.
Yes, sir. Please go ahead.
I just want the clarification on the export side. So, previous quarters we have seen the export contributed around 18% or so, and still we are on that number only. I mean, we can see here 20% of this quarter's revenue has been contributed by exports. So going forward, do we look to increase this number? I mean, if we even look at the order book, 280 CR is from export side. Am I correct?
Yes. Yes, that is our current year's number that we have targeted.
Current year's number. So my question,
275 to 300 crores is what we are aiming at, right?
Okay. And regarding volume, yes, see, currently export has contributed about 13% of the total turnover, top line, as far as the financial year 26 is concerned. We aim it to maximum up to 20%. So it will be gradually, we will be increasing, like say as we say 10,000 tons in the next year. Say if we put 10,000 out of 85,000, what will be? It will be around 14-15%, right?
Is your question Q4 versus Q3? This is one reason is revenue recognition. You can't recognize the revenue till it reaches the
correct.
Goods in transit
part, yes. The cutoff was somewhere around February 10th or 12th. Iske baad ka shipments we have not been able to recognize as revenue this year.
Correct.
Okay. So that amount got deferred. Deferred.
Yeah.
It will be booked now, this quarter.
This quarter. Okay. So this quarter will be highest in the terms of export revenue.
So now it will be consistently good, I think. More or less.
Because this large order that is coming into execution, that will go on for another 7 months. So we'll be consistently delivering a certain quantum month on month.
Okay. And may I know the amount that got deferred?
It would be difficult, but goods in transit would be around 8 to 10 crores. Yeah. We'll have to check.
We'll check that number and get back, yeah.
Okay, no worries. And what is the current capacity utilization? And after the Phoenix plant at Sanand get the commission, what will be the utilization rate?
See, currently the Sanand plant last year executed, meaning utilized about 75-76%, which is the peak, right? After 20,000 tons expansion, which is undergoing right now, in the current fiscal, with the output that we have planned, it will be somewhere around 65-68%. Chennai Cheyyar plant, last year we did about 50-55%. This year we will be crossing 68-70%.
Got it.
हमारा क्या है कि because of our product mix, 75% would be the peak.
And regarding the raw material cost, company have plans to hedge against the steel prices or the gas prices?
नहीं, हमारे steel में हमने in our country there is no hedging possible.
So Niket, just to add, as we have been explaining, we try to cover the main raw material steel to the maximum extent possible for the given order inflow plus anticipated orders which are at the final stage. Problem क्या होता है? You can cover with all your calculations, you can't go beyond 80-85%. 15% open रह जाता है. So ये जो मार पड़ा है ना, वो 15-20% जो open रहा उसका है. What is covered means we either place a firm order, either it has to be in my inventory or it has to be already ordered at the committed price by this big steel mill.
Mm-hmm.
This is the only way you can hedge.
Yeah.
And we have found it to be the most effective.
Correct.
Because in no quarter you would see such a steep volatility. That's the real pain point.
This is an extraordinary situation. We can never plan for such situations, you know.
Okay. Got it. So
I'm sorry to interrupt, sir. Could you please return to the question queue? We have several participants.
Fine.
Thank you. Participants, as a request, please limit your questions to 2 questions per participant. We have many participants awaiting their turn. The next question is from the line of Vaibhav Shah from Equirus Securities. Please go ahead.
Thank you very much for the opportunity. I have just one question. So, what is our total employee strength at the FY26 time, and how will it grow over FY27 and 28? And it will be really helpful if you could break it by the segment or the plant wise.
Employee strength, if we call white-collar professionals, it would be around 440 in Phoenix and about 150 to 160 in Proflex. This is the professionals. Workers would be total, both plants put together, 1,600.
Understood. Thank you.
Thank you. The next question is from the line of Arvind Arora, A Square Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, so you mentioned 80% contract in the current order book is we hedge and 20% is open. So is it we hedge and that's how we protect our margin, or do we have price escalation clause in our contract with the client?
No. See, ours are fixed price contracts because execution time-wise, it is anywhere between 6 months and 12 months. They don't go beyond a year. And the industry trend is such that it is only based on fixed price contracts. So the moment we bag any of the orders, we secure this 80-85% material either through our hard inventory in transit material, or we will secure that 85% of the new order quantity with the mill. At least the price is fixed. Only thing that remains open is that last 15-20% of RM, which generally is booked when my engineering and design gets finalized.
Okay, understood. And sir, in the inception you mentioned that there is a difficulty in the conversion to order win from last 3 to 4 months. So is it because of these issues that you have mentioned, or this is like some other issue at a company level, or this is a theme at the industry level?
I think you're talking to export conversion inquiry into orders, right? This was in context with export orders.
You're talking about the timeline between inquiry and order closure? That's what you're wanting to know?
Yes.
Why there is a slowdown in that?
Yeah. See, generally in the US market, it takes around 6 to 8 weeks. Okay, what we have experienced in the last 2 months, that 8 weeks has become 12 weeks.
Or even 16.
Or even 16, because the larger the project becomes, the financial closures, etc., take a much longer time. And in the scenario of rising costs, the end users generally take their own time, make sure that all the resources are in place before they would get into any order closures with vendors like me.
Yeah, there is deep inflation in US also.
Inflation bhi US mein बढ़ गया है, so oil and gas prices, petrol prices have gone up to $4, and in some cases in California $7. So all these factors are weighing down on order closures and other matters.
So will there be any short-term impact in the closing the order, like due to there might be a speculation from company side, like to wait for 3 months to so that the price could decrease or something like that?
Yes. There is, meaning, let's say for example, I am a customer who is not hard pressed on putting my new project up, would probably choose to wait for 2 months and see how the prices are going. That is a possibility. Yes.
Understood. And sir, on the data center scene, like when you are announced on the street, like as you said, right now it's not possible, and there are certain works which is going on. So any timelines by when you can announce something material on this data center?
It's an ongoing process, and these are very, very large projects, and a lot of engineering goes into it. So the customer himself takes a very long time putting all the specifications in place, and then when it comes to me, my engineering department takes equal amount of time determining the design and the quantum of steel that is going to go in the building, right? So it is a process, and the day we have that clarity, we'll be more than happy to share it with you.
Okay, understood. Thank you, sir, and all the best.
Yeah, thank you.
Thank you. Participants, please limit your questions to only 2 questions. The next question is from the line of Ankur Gulati from Genuity Capital. Please go ahead.
Thank you. Sir, अगर मैं अदर इनकम भी ऐड कर देता हूँ तो कुछ 11.9% का EBITDA आया. एक तो आपने कुछ फॉरेक्स लॉस बोला था, वो थोड़ा एक्सप्लेन कर दीजिए. एंड सेकंड, 12% EBITDA से अगर 13.5 जो EBITDA पहले था टैरिफ से पहले, वहाँ तक जाने का what will be the right path?
My plain EBITDA is 12.48%, and if you consider this forex, which is 0.5%, so that put together makes 13%.
Other income.
The other income is covered.
So as I said, Ankurji, that other income has 2 components. Other operating. That other operating we also include the other income. But even if we exclude the other non-operating income, then also it will be in the range of about 12.5%.
सर सॉरी, थोड़ा सा एक्सप्लेन करेंगे, बिकॉज मेरा नंबर आ रहा है 43 odd crores on 363 रेवेन्यू. वो तो कुछ 12% बन रहा है, तो 50-70 basis point gap है, if you can help us.
No, sir. EBITDA is always with other income, total other income, as we mentioned in the P&L, right? So it is 11.9% what you are calculating, right?
Hanji.
That is, you removed non-operative income, right? That is to the tune of what?
5.3.
That is to the tune of 6 crore for full year, right?
Sir, I'm looking at Q4.
You removed that other income which is non-operative to the tune of 6 crores. That's why you get 11.91%. Correct.
And then you add your forex part, it will become about 12.5.
12.4.
Adjusted, yeah.
And this forex loss is because of what? Hedging or what?
No, this sudden rupee depreciation and translation, mainly translation. You close your accounts at 95 rupees.
See, post-war situation in February, the dollars increased drastically from 89.90 to 94.78, and this has resulted into conversion of all the liability at 94.78, which is notional. Right, but we have to account it for in the books of accounts as per the accounting standard, so which is to the tune of 3.83 crores, and this is the result.
Okay. Fair enough. And sir, when does the lower tariff start? When in the quarter, last quarter, what time did it start?
Implemented. It's implemented. So I think it came into effect sometime in April. I forget the exact date. I think it was around the 6th of April. So after that, whatever our consignments reach will have an imposition of 25% sectoral tariff.
And let's say I think
I'm sorry to interrupt, sir, but could you return to the question queue?
Can I have one more last one, please?
Okay. Yeah.
So export में आपका आप margin जो पहले guidance था 17, तो let's assume 17 or 14. This will now start showing up in Q2 because आप अभी शुरू करेंगे delivery होते I think 2 महीना लग जाएगा, right?
Correct.
So 15 to 17 of export and whatever the domestic is, let's say 11, 12, that is something which we'll see in Q2. Is that fair?
As I said, you are broadly right, but we have decided not to give any specific guidance till we get more clarity.
Yes, because my input costs are still not in my control.
But domestic में 12 तो है ही नहीं. So that 11, 12 is a very, very good way of saying, but there is nothing like 12 in domestic.
Fair enough. Okay, I'll fall back in queue. Thanks.
Thank you, Ankur.
Thank you. The next question is from the line of Devang Patil from Sameeksha Capital. Please go ahead.
Sir, I have a question on the working capital. If I see the operating cash flow, it's minus 36 crores. Within that, there's an outflow of 179 crores because of trade and other receivables. If I just look at the receivables in the balance sheet, it's up 47 crores, but in the cash flow, the number is much higher. So the question is, what explains the outflow on OCF? Are there any one-offs in this?
Sir, my working capital cycle is mix of the assets, current assets as well as current liabilities. As we have put it into the presentation, that is coming to 39 days for financial year 26. Right. Now, what?
Just a minute.
Just a minute. See, now what happens, if you see working capital changes, which is affecting my cycle, working capital changes is impacted by my payment to creditors or my inventory building, which is again payment to creditors. Now, right now, if you remember, my IPO includes 65 crores of GCP, that is general general corporate expenses, which is mainly used for the working capital. Now, as that fund is available, I will obviously make the payment to creditors. So, which will result in two ways. It will impact my working capital cycle adversely, as well as it will impact my cash outflow from operations. Because if I am paying to my creditors,
because you are using long-term sources to pay creditors.
It will be usage of the fund, right? And GCP is not part of the working capital inflow.
Therefore, it is showing negative,
impairing my total cash outflow from operations.
Okay, I got your point on payables. On receivables, I will connect with you offline. I just have a quick question on the tariff reduction in US. You had a large 200 crore order previous quarter. Now that the tariff has reduced, will you get to retain the benefit or is it passed on?
A part of it. Because that was the original clause in our contract that we have to, in case of any increase, there would be a sharing of the tariff, and in case there is any reduction, then also there will be a sharing of the benefit. So a portion we are going to keep, and a part of it the customer is going to be taking advantage of.
Right, sir. Thank you so much.
Yes.
Thank you. The next question is from the line of Rishit Zaveri from CBA Asset Management. Please go ahead.
Thank you for giving me the opportunity. Actually, my questions have been answered. Just one follow-up on the previous participant. What will be the Q4 utilization for both the plants due to the war?
Q4? My Sanand plant would be around 75%. Sanand plant is operating, whole year it operated at peak level, right? And my Cheyyar plant about 52 to 55%.
So, because the war has been extended, even and spilled over in Q1, what do you see, how much would be the impact on the utilization for Q1?
I see, basically it is going to be a peak at Sanand because I have adequate orders to continue and keep my shop floors loaded at both the plants.
Even Cheyyar will improve.
Yeah.
100%.
Yeah. Okay, understood. Thank you, Malu.
Yeah.
Thank you. The next question is from the line of Guru Darshan from Kitara Capital. Please go ahead. Sir, your line is unmuted. You may go ahead.
I'm audible?
Yes, sir. Please go ahead.
Yes, sir. Thank you. I just had one question. It's more of a clarification. Despite maintaining 100 days of inventory, your production in March was impacted. Considering the war situation escalated towards the end of February, of course, I'm assuming majority of raw material is in the form of raw materials and majority of inventory is in the form of raw materials and work in progress. And assuming 35 to 50 days inventory sits in production plant, I just wanted to understand the disconnect between you saying production was impacted versus 100 days of inventory.
Because Guru, हमारा जो 15-20% हम open रखते हैं ना, that is generally non-standard items, and without having these non-standard items in my inventory, it affects my supplies because the customers generally don't allow supplies to happen if the materials that are delivered are not installable. Okay, and that is why some of my large projects the deliveries got impacted. As I said, in the month of March, 2 large mills which are our major suppliers, the entire month their mill was shut. I was required to depend only on one mill, and that one mill had pressure of deliveries from all manufacturers like me as well as 100 others, right? So my delivery times got affected. Even that one mill that was running was encountering gas shortage, right? Because gas is one of the main ingredients to run the plant. So वहाँ से भी मेरी delivery, so it was a double whammy, right? एक तो demand भी थी ज़्यादा और gas shortfall भी था. So what I was supposed to get in 2-3 weeks, let's say it took about 7-8 weeks to get the deliveries. That's what impacts. So that last 15-20% of the material also make a very big difference.
Okay, understood. Congratulations on the good numbers, sir, considering the challenging environment. Thank you and all the best.
Thank you for understanding. Thank you.
Thank you. The next question is from the line of Rajat Baldeva from Kizunu Wealth. Please go ahead.
Yeah. Hi, sir. Thank you for giving me the opportunity. Just one question. In Q4, order inflow was 387 crore, down sequentially from 480 crore in Q3, and the current unexecuted order book is around 1083 crore against a revenue of 1260 crore, which implied a order book to revenue ratio of 0.86x. So how do you frame the adequacy of this cover, and what does the current bid pipeline look like in terms of value?
Current bid pipeline would be to the tune of 1,000 crores. These are inquiries from different sectors, generally the industries that we cater to. It would be a good mix of large orders, medium orders, and small orders. So the bid pipeline is strong and we are confident. Now, let's hope it remains that way in the coming time, because still, even as we speak, the uncertainties are still looming.
Okay. And sir, just one last question. Just want to confirm, correct me if I am wrong. Given the situation because of steel price volatility, 20-25% steel price hike from 49,500 per ton to 58,500. So, and demand in PV sector is also robust. So, are you being able to pass on the price hike? Correct me if I'm wrong.
नहीं जो हम नए ऑर्डर्स के लिए कोट करेंगे उसमें तो नया प्राइस ही ऑब्वियसली लेना है, राइट? So that's what we are practicing, that we'll never hold back the increase if there is already not a contractual sign-off happened between me and the customer. Unless and until I receive the advance, the price is not fixed.
Okay. Thank you. Great, sir.
Yeah.
Thank you. The next question is from the line of Dharmil Shah from Dalmus Capital Management. Please go ahead.
Hi, thank you for the opportunity. So just wanted to confirm few things. The volumes you mentioned for exports were 7,000 in FY26 and 2,400 for FY25, right?
Yeah, that's right.
Yeah, so I mean, just continuing on this, I mean, these numbers, export realizations are somewhere around 2.3, 2.7 lakhs per ton. Versus, I mean, if I compare it to the domestic realization, it's almost 2x of what we earn in the domestic market. So why is this difference? And even if we compare it to some of the US PEB companies, it's still, I mean, quite high. So can you just explain what the difference is and why is it so stark difference?
See, basically there is a large chunk of materials that we buy from the local market. Okay, they are called bought outs in our language. Okay, there are buildings which require several such different kinds of bought outs, and the price of those bought outs coming from the US is comparatively much higher than what it is in India, right? They can range anywhere between lakh rupees a ton to, let's say, 2 lakh rupees a ton. It depends on the item that we are sourcing. So it would have so happened that in the orders that we executed where you realize this price, the amount or the quantum of bought out from the US markets would have been on the higher side. And that's why this price per ton that you see is 2 to 3 times higher than the Indian prices.
Plus freight, plus
freight भी है और ये duty का भी थोड़ा impact रहता है. It's a combination of everything.
Understood. So the parts we source from US, I mean, are those any different in terms of?
Yeah. The qualities are different. The specifications are different. There's many variables. Because there in the US market, the aesthetics of the buildings that we generally deliver are very different than what we actually do in India. It's a mix of commercial as well as industrial buildings, and not only industrial, whereas in India, in 99% of the cases, it is only industrial.
Understood. But despite duty, in fact, realizations have come down, at least in the export business. But maybe it will be a product mix.
वो भी impact आना बाकी है, meaning we'll see that impact in the coming quarters.
Understood. And again, just comparing the other expenses across the 2 year, it has almost increased by 90% from 88 crores to 161 crores. Probably you already explained, but just wanted to know what was the major reason.
Major thing is export, as we said, because see, we during the last 2 to 3 years, our export has increased multifold. Say like 65 crore to 165 crore in 1 year, right? So based on that, all export expenses, which is duty as well as sea freight and local transportation in USA, is clubbed and put as an export expenses in the other expense schedule, and which is the major component of that increase.
Abhi aage bhi badhega in the coming time. You'll see this number jump up because the number that we are targeting in this year is again almost double. I think if not double, then at least 80% more. So you'll see more of it coming in the coming time.
40% of the total expenditure is export.
Yes.
Other expense. 40% of the other expense is export expense.
Got it. And if we look at the cash flows for last 2 years, our cash flow from operations have been quite weak. Any particular reason?
No, sir. As I explained earlier, see, cash flow from operations get worsened when we make the payment. Now, since last 2 years, due to paucity of fund, what we do is we do cash purchases, right? And on of IPO fund availability of GCP also we made cash purchases and payment to creditors, which has resulted into lower, means negative cash flow from operations. Actually, if you see my balance sheet, we are sitting on the 90 to 100 crores of cash balance, which is not counted in this thing, right? Which is the reconciliation figure. So if you see, just take one figure of 64 crore of GCP and my cash flow from operation is say 30 crores. Negative. So if you remove this 64, it is 34 crore positive rather. Because 64 doesn't form part of my working capital means operations cash.
Simply put, when long-term resources were used to reduce your creditors and we are buying cash, so there is always a positive generation, but additional long-term resources used to reduce the level of creditors, and therefore this dichotomy appears, but it is actually not so.
Positive thing.
Yeah.
And this long-term fund was used because of the object in the IPO.
Yeah, that's fine.
Understood.
Yeah.
Yeah, that's it, and thank you all the best.
Thank you.
Thank you. The next question is from the line of Vaibhav Shah from Equirus Securities. Please go ahead.
Yeah, Vaibhav.
Thank you very much for the opportunity. So just continuing on my previous question, while you have mentioned employee strength at the FY26 end, could you mention how it will grow over FY27 and 28?
Sorsona કેટલા માણસો?
Acha, Sorsona, my production team will go up by about 200 people in Sanand. I'm talking about the workforce. And if you see my shop floor engineers and supervisors and my project management department, it would be around 25 to 30 professionals.
Nothing much, really.
And for chair, any
chair, we are just recruiting to fill the gap. उसमें अभी कोई expansion है नहीं. So whatever number of people are missing currently, that we are planning to fill out, and that would be to the tune of around 25-30 people. This is the workforce, not professionals.
Okay, understood. Thank you.
Yeah.
Thank you.
Thank you. The next question is from the line of Rishad Zaveri from CBA Asset Management. Please go ahead.
I think, operator, this should be the last question.
Yes.
Sure, sir.
Thank you. Thank you for the follow-up. Sir, I just wanted to understand, because we are giving cash purchases to procure the raw materials, what would be the margin alpha we are getting of the disadvantage?
Yeah, cash purchase always give some benefit out of it, but very little, means 0.5% or so.
Okay. Thank you.
On that purchase.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to the management for closing comments.
Yes. Thank you, everyone. On behalf of the management of MNB Engineering Limited, we thank you all for joining us on our post-earnings call today. We hope we have been able to address majority of your queries. You may reach out to me or our investor relationship partner, Ernst & Young, for any further queries that you may have, and they would connect with you offline. Thank you. Moderator, we can close the call now.
Yeah.
Sure, sir. Thank you very much.
Thank you.
Thank you all. On behalf of MNB Engineering Limited, that concludes this conference. Thank you all for joining, and you may now disconnect your lines. Thank you.
Bye.